Coming up in today's show, stocks finished the week mostly lower, led by the Nasdaq as we get more inflation data today. Why the bulls are still getting excited. The Fed president says there's still more work to do on inflation. Oil finishes another week higher. Biden takes a swing at China. And Nvidia and a few other key stocks continue to break down. Hey, what's up guys? Happy Friday or Saturday, wherever you are in the world. Welcome back to the Click Capital Daily Market Show. My name's Jared and I'm going to run down all the most important news, data and charts from the markets for you today. And there's a little bit of a soft finish to the week here, led by semis and Nvidia down almost 4% and more strength in the healthcare and energy sector. And to switch in the heat map over to the weekly performance, we can see today's performance was an extension of the week, with semis leading the way on the downside, with Nvidia finishing down 8.5% on the week. And we also saw the other big guys, Microsoft, Apple, Meta and Tesla all finish slower as well. And the winning sectors this week was healthcare on the back of really good earnings out from Eli Lilly, and energy stocks moving higher on the back of a strong price in crude oil. And so we had CPI inflation data come out yesterday, which came in a little lower than expected, but still was an uptick month over month in inflation. And then we had the producer price index come in today, a little bit higher than expected, growing 0.3% month over month versus the 0.2%, not a huge increase. But nonetheless, the bond market reacted and increased the chances that the Fed will hike rates to about 1 and 3 at the November meeting. But for now, it looks highly likely the Fed will pause when they meet again next month. However, the jury's still out whether the Fed is done in this hiking cycle or not. However, some market commentators are saying the Fed is done hiking rates and they could even start cutting early next year. That's Fundstrat's Tom Lee and respected economist Mohamed El-Aran saying the Fed's going to start cutting early next year because inflation is rapidly cooling, with July's CPI report coming in below forecasts. And they're saying they have to cut rates, otherwise it's actually restricting the economy more. And so hopes of the end of the hiking cycle, coupled with a pretty good Q2 earnings season, is leading other analysts to say to buy tech stocks now, as that we could still have a 15% rally into year end. And that's Wedbush's Dan Ives, who says with the Fed waving the white flag on rate hikes, we see a green light risk on environment into year end. He went on to say AI remains in the spotlight, driving success for some and headwinds for others. He's comparing the point of time in AI now to the internet in 1995 and said Rome was not built in a day and neither will the AI ecosystem. But let's be clear, this build out is unlike anything we have seen since the internet in 95, and the ramifications are just starting to ripple through the consumer enterprise landscape. And if they're right, now could be the time to buy the dip on AI, as we can see here in the BOTS ETF, which invests in companies in robotics and artificial intelligence. And that's been pulling back quite a bit compared to the rest of the market and is now in technically oversold territory on some reversal signals after having a stellar performance so far this year. However, there's still some key points the bulls have to answer to. And so whilst it's been true the consumer economy has been strong so far this year, better than expected, and there's a lot of bullish optimism towards a soft landing scenario, there's still some pretty big hurdles the bulls have to get over, including can consumer resilience last with rates this high? The second being, what's the impact of tighter lending standards today? And we've been seeing that ever since the collapse of Silicon Valley Bank in March. A lot of banks have been tightening credit standards, and rejections on loan applications are coming near record highs. The third reason is the VIX too low, and that could be a sign of a lot of complacency out there, which is typically a contrarian signal. The fourth reason, something else could break out there. We've already seen regional banks, commercial real estate, and cracks showing up in the US sovereign debt. And the fifth being, is the US stock market overvalued compared to the rest of the world? However, against that last point, I would argue that the US stock market does deserve a premium versus the rest of the world, because it's structurally a better place for capital to rest. And we've still got Fed president members that are not all on the same page as each other. And that's San Francisco's Fed President Mary Daly, who said there's still more work to do on inflation. She said the last CPI print that came in is good news, but she said it's not a data point that says victory is ours. There's still more work to do. And she pointed to some factors that could delay inflation's downward trajectory, including oil prices and housing. And she said whether we raise another time, hold rates steady for a longer period, those things are yet to be determined. She pointed to core inflation still almost 5%, and said we need to see that come back to pre-pandemic levels if we're going to be confident that we can get to 2% on a sustainable basis. I'm going to need to see some traction in getting there before I feel comfortable that we've done enough. So the Fed itself and the market are still not 100% sure whether they're done hiking. And why we pay so much attention on this channel to inflation data and the Fed is because they're the biggest influencers on the short-term interest rates that people borrow at, and that's the biggest driving force in the economy. And you can think of interest rates as like a huge gravitational force in the markets that basically all assets are priced relative to. And so knowing interest rates is really important. The biggest input into interest rates is inflation. And then one of the biggest inputs into inflation is the price of commodities, like oil, since it's such a huge input in the economy. not just in transport, energy, but also in the production of consumer goods and industrial production as well. And we've been seeing oil march higher now for the 7th straight week. It finished up on the back of data showing tight supplies out there, production cuts from Saudi Arabia and Russia, and we can see that in the price action of crude oil futures. In a strong short-term uptrend, but sitting right at this big resistance level around 84 a barrel, and just taking you out to a weekly chart, that's the level it has to break through to put in a higher high, and then we can say with confidence we're in a medium-term uptrend. And if that were to happen, that's going to put a lot of upward pressure on inflation, which could then further increase the chances that the Fed is going to hike again, and that could further upset tech stocks, which are already in a short-term pullback underneath the 50-day VWAP, but aren't so deeply oversold yet, so still could have a way to go in this pullback, and could potentially turn into a full-on medium-term correction in the market. And so if you still think there's risks out there in the economy and the market, and we could go into a recession next year and the stock market is overvalued, and you want to potentially hedge your long-only portfolios from a prolonged bear market or full-blown stock market crash, then I'd encourage you to check out our Only Bears trading strategy over on the Collective 2 platform. For my regular viewers out there, you may previously remember this strategy has been known as equity long short. However, back in July, I rebranded it to being short only and renamed it from equity long short to Only Bears, because this strategy now only takes short positions. It always has 20 short positions open, combination of short-term swings and medium-term tactical positions, using both fundamental and technical analysis to find overvalued stocks, uses just a little bit of leverage, and with this little pullback we've had in the market recently, the strategy is back to outperforming the S&P 500 and is currently up 8.4% year to date. And if the market's going to keep pulling back or potentially go into a larger correction later this year or early next year, then this strategy should significantly outperform and provide a great hedge for the typical long-only portfolios out there. The cost to subscribe is $95 a month, and that gives you complete access to the strategy with real-time alerts, and you can pay a little bit extra and have it automatically traded in your Interactive Brokers account. So if you're interested in that, check out the link below this video. And like I said, this is a great hedging strategy if you are worried that the market is going to turn. Another news out today, we saw President Biden throw some mud at China, calling their economy a ticking time bomb amid growth and demographic issues. He even pulled off the gloves and said they've got some problems. That's not good, because when bad folks have problems, they do bad things. And he's not wrong, because their economy is experiencing deflation, a record exodus of Western capital, youth unemployment rate at 21%, their exports fallen off a cliff, and more government limits on US investment in Chinese tech. And just looking at the China A50 index today, fell over 3% in a huge reversal, and it's still not clear yet whether the Chinese market has bottomed and still faces a lot of uncertainties on the horizon. And so while the market's been pulling back this last couple of weeks, it's still too early to call a short-term technical bottom. And that's because the fear and greed index is still elevated at 66. Typically, the market only bottoms on fear or extreme fear in the short and medium term. And a little bit of a quiet day for a Friday in the options market, pretty much just coming in at average 40 million contracts traded, and only slightly more calls for a change this time, 52%. Did see a little bit of an uptick in dark pool traders buying the market today, however still diverging from the market overall these last couple of weeks. Corporate insiders aren't doing a whole lot of buying of their own stock at these levels either. And just looking at our S&P 500 oscillator, it is getting down towards oversold territory at 42 now. We're still not quite there, and just looking at the last couple of times, our custom market sentiment indicator went into oversold territory, was back in mid-March here. Then before that did a double bottom divergence when the market last bottomed back in mid-October on that big bullish engulfing pattern. Then we had a brief little dip in September and June and May. And so the last time the market bottomed at 3,500 on the S&P, it put in this big bullish engulfing candlestick pattern here where we opened a lot lower, then finished a lot higher. And because that candle engulfs the previous candle, it's called a bullish engulfing pattern. And if we look at what happened 2 Thursdays ago, we got the exact same opposite pattern up here where we gapped up higher and finished a lot lower, creating a bearish engulfing pattern. And so far it looks to be playing out. However, just doing a bit more technical analysis on the SP 500, back on our regular charts, we can see we've just closed below the 50-day VWAP. We're still a bit above the bottom buy-sell band, which is currently at 42.91, and our DSI is only at -2 and hasn't gone into oversold levels yet. So it's still a bit of a shallow pullback, and same deal on the Nasdaq as well. Even though it is a bit more oversold, it still could have a ways to go before we could call a short-term bottom. And just looking at our sector trends table, we do have most sectors underneath their 5 and 20-day moving averages, and about half of them underneath their 50-day moving averages, with the strongest sectors being oil, gas, energy, healthcare, and aerospace and defense, still in uptrends on all timeframes. So there's not a lot of bearish breadth out there. There's a bit of bifurcation going on, a bit of rotation, and even though we've been seeing weakness in sectors like meme stocks, cannabis stocks still pulling back down to the bottom of their support zone, AI bots, semiconductors look to have turned down here on volume today, ARC, and IPO, and a bit of a turn down in airline travel stocks that have been doing well this year, and got a bit of a pullback in the financials, industrials, and transports. We've seen some pretty good breakouts in energy stocks, oil and gas in a short-term uptrend, and healthcare holding up a bit better than other sectors as well. Apart from China, all other international stock indices are holding up a bit better than the American ones, and another VIX Friday falling down on its knees underneath the 15 handle now, and realized volatility very low as well, with the market moving at an annualized rate of 8.87%. We are seeing a bit more continued hedging going on in the market, with the put-call ratio in equities jumping up to 0.94 today, and that skew index is broken down below that trend line at 135. It's the price of tail risk insurance coming down a little bit. Short-term breadth's trying to bottom here, with 36% of stocks above their 20-day average, and still the majority of stocks 60% above their long-term average. But once again, we're seeing the amount of stocks making new lows on the Nasdaq outpace the amount of stocks making new highs today, 59 to 34. And a bit of a turn down in the growth versus defensive sector spread here, along with high beta stocks versus low volatility stocks, and growth versus value as well now in a short-term downtrend as well. And there's the commodity growth spread, copper versus gold, also looks to be going into a short-term downtrend, and inflation expectations continue to tick higher. It's got that little surprise upside on the PPI data today. We can see that helped government bond yields move up. Now got the 2-year just below 490, and a bit of a move up in the back end as well, with the 10-year at 415. Those higher yields saw bond prices fall a bit today. TLT moving back down to support, and I've got a feeling we're going to come back down to the low 90s on this, potentially over the coming weeks, but I guess that's all dependent on the next CPI report we get next month, and we'll just have to see whether those higher commodity prices filter through into inflation data. Market doesn't look too worried just yet, because we can see the high yield bond ETF still sitting at its 50-day, and those higher yields gave a little bit of a tailwind to the dollar index here, breaking out some new multi-week highs, and Bitcoin continued to trade with low volatility in this sideways pattern. Higher dollar put a little bit of pressure on commodity prices today, but still in a short-term uptrend, and gold looks to have closed just below its 50-day VWAP. However, I'm not ruling it out just yet. If we were to close below 1900 an ounce, then I'd have to say it needs a bit more time before we can start talking about all-time high breakouts. However, I still think we could break out above $2,000 an ounce any day or week now. There's a price of uranium still holding up pretty good, and a little bit of a pullback and one of the best performing commodities this year, orange juice. We've already had a look through the stock sectors today, and just over to popular stocks, there's BlackRock, still on a short-term downtrend. JP Morgan holding up pretty good. Got a new multi-month breakout in ExxonMobil, Chevron as well, and just looking at the biggest stocks in the market, Apple managed to find another new low here today. Same with Microsoft and Google and Amazon, which have been holding up the best out of the pack, appear to be slipping a little bit here. And the big one today, technically speaking, is Nvidia, finishing down 3.6% on above average volume. Could be getting close to short-term oversold levels here. However, we now look to be in a short-term downtrend, which it pretty much hasn't been in all year. Same with Tesla, continuing its short-term downtrend today, and Meta looks to have just lost its 50-day VWAP for the first time since November last year, and Netflix looking a little weak here as well. So mega cap tech definitely looks to be a bit weaker than the rest of the market here, largely amplified by that move down we got from Apple last Friday out on the back of their weaker earnings. But like I just said, it hasn't brought the entire rest of the market down with it. We've still got energy, oil and gas holding up well, along with a bit of a rotation into the defensives like healthcare. And there's a look at meme stocks today, a bit mixed out there, still getting some big moves in both directions, and got a little bit of a pullback in Disney after their good day yesterday on the back of their earnings. And some of the regional banks continue to trade well, but a little bit more of weakness in the bigger guys like Citigroup and Wells, and Charles Schwab still holding up above its 50. Okay, just a look at the weekly charts to finish out the week here. We can see we look to have rejected off this 4600 on the S&P 500, now finishing lower for the second week, and most indices appear to have rejected off resistance zones. There's the equal weight S&P, the Nasdaq as well, breaking that tight trend line we've had all year, and a little bit of bearish breadth in the tech space as well with the Nasdaq equal weight. The Dow Jones Industrial still holding up a little bit better. There's mid caps, the Russell 2000, and micro caps. And just looking at the weekly chart of the VIX, still really low. Market doesn't look to be worried at all. However, this could be a bottom, and this pullback that we're currently in still could have further to go and potentially turn into a medium-term correction. However, I think we'd need a surprise from that. Either some unknown piece of news or maybe some higher than expected inflation data could further increase the chances that the Fed's going to hike, and that could further upset tech stocks. Till then, we'll just have to play it as it comes, and as always, follow the price action. Thanks very much for sticking with Click Capital. I hope you all have a great weekend. Appreciate all your support, and I look forward to making another video for you guys come Monday afternoon. Cheers.